Howdy, Jacob here. Today we're looking at Box. It is in the software industry, 3.7 billion market cap on 3.5 billion enterprise value. If we just look at what we're seeing here, we see that they were reinvesting all of their money until just about 2 years ago. Well, they could still be reinvesting, but reinvesting so much money that they weren't profitable to where now they're just starting to become profitable. They have a fantastic gross margin, about 75%. Their operating margin is still low single digits, but even with that low operating margin, their return on invested capital is phenomenal. And so growth amazing, but it has been slowing. Let's look at the income statement, see what R&D is doing. So R&D is heavily expanded, 66 million in 2015 to 250 million in 2024. And so even if they cut that in half, 20 you'd increase net income to about 200, 200. You're looking at about 20% margin there. So that's pretty impressive. Right now, we are seeing about 10%, but which is still great. But that just shows that they have a lot of room to grow on the margin expansion, in my perspective. They have been buying back shares, interestingly enough. So that means cash flow has been more positive, which we do see here. Cash from operations heavily positive, but also stock-based compensation is hugely up. So that means stock-based compensation goes into cash from operations. Their capital expenditures are very low. It doesn't take much to keep the business running, keep the doors open. So they use a lot of their money for share repurchases, debt reduction, and reinvestment. They says they pay a dividend. Okay, maybe these are one-time dividends of just 15 mil. That's fine. Balance sheet. How much debt do they have? So about 400 plus, almost 500 million cash-like products with 371 million long-term debt. So we're not concerned with that balance sheet at all. I mean, everything looks very positive to me here. Let's start making some assumptions. So on the revenue change side, I mean, they're still a young company. Provide cloud content management platform that enables organizations of various incorporated in 2005. Okay, so maybe 8% seems pretty reasonable. And then for um, terminal value, I mean, that return on invested capital is amazing. If they can keep that going, that would be phenomenal. Why does it say operating margin? So income tax was positive. So that maybe looks like a one-time thing. So even if it was 60, that's fine. Not a super big concern. Um, so free cash flow, terminal P, I think the 18 makes sense to me at the end of 7 years. For margins, I mean, let's do 2025. And then for share change, I mean, they use 60% of their free cash flow to offset stock-based compensation, leaving about 40% to reinvest, all those other things. I think that makes sense to me. So let's just do zero. Okay. So we're saying the company's stock price needs to fall 30% before you get the return looking for here. This is a type of business, classic software business, net income. They're still learning how to make money because they're reinvesting everything in R&D. But on the free cash flow side, through both depreciation and amortization, adding that up, and then also stock-based compensation, you're seeing heavy production of free cash flow. So that's more positive to me. And again, you just have to take into consideration stock-based compensation in your share change analysis. So this is assuming that they're using 60% of free cash flow to buy back shares to offset stock-based compensation, leaving 40% to reinvest to get these types of returns, make acquisitions to get these types of margins and such. And so to me, I mean, great business. I'd love to do a deeper dive, and really 30% drop. We're probably not too far away from me performing that. I hope you enjoyed the video. Have a great day.